Imagine stepping onto a sprawling factory floor, the air thick with the hum and whir of machinery, keeping production lines churning. Now pause for a moment and consider. How do they actually keep all of that running? Who ensures there's a seemingly endless supply of nuts, bolts, safety gear, specialized tools, and every other consumable needed day in and day out?
It's a good question.
The far more intricate and strategically vital question than you might initially think, touching on the very arteries of global industry. Okay, let's unpack this. Today, we're embarking on a deep dive into Fastenal Company, Picker Fast.
Right.
And this isn't just about, selling screws.
Not at all. Much more to it.
It's a compelling narrative of profound transformation, a relentless pursuit of market dominance, and really a masterclass in adapting within a multi-trillion-dollar industry.
An industry that quite literally underpins nearly every product you interact with.
Yeah, what's fascinating here, and our mission today really, is to unravel how Fastenal has so successfully evolved. They went from being, a traditional distributor.
Right, just selling parts. Exactly. To becoming this indispensable, integrated logistics and technology service provider.
Okay.
So we'll explore the innovative strategies that fuel their remarkable growth, dissect the financial realities of their journey, and critically assess whether their, frankly, impressive valuation truly reflects the enduring strength and adaptability of their business model.
That valuation piece is key.
Definitely. Ultimately, we're looking at how they've mastered what's often called the last mile of industrial supply, making themselves an irreplaceable partner to their customers.
And to guide us through this intricate landscape, we've meticulously pulled together insights from, extensive investment analyses, Fastenal's own annual reports, their quarterly earnings calls, and comprehensive market research studies.
A lot of material.
Yeah, quite a bit. We're here to distill these nuggets of knowledge, ensuring you walk away truly well-informed about a company that's quietly yet powerfully driving a huge part of the global economy. Before we delve into the sophisticated operations of Fastenal today, let's maybe set the scene a bit. Talk about their beginnings.
Good idea.
Like many industrial giants, Fastenal started with a much simpler premise. They were primarily a distributor of fasteners. The actual nuts and bolts that literally hold everything together.
The basics.
Exactly. It was a straightforward business model.
Yeah.
Buy in bulk, then sell those essential components to other businesses. But what's truly remarkable, and what we really want to explore, is the massive strategic evolution they've undergone, which has fundamentally redefined their role in the industrial supply chain.
Indeed, the transformation is profound. If we connect this to the bigger picture, Fastenal isn't merely selling products anymore.
Right.
They've become a genuine supply chain innovator. You should think of them less as a store you go to when you need something, and more as a deeply embedded strategic partner within a company's day-to-day operations.
Embedded. That's a good word for it.
Yeah. This pivotal shift from a purely transactional supplier to an integrated, essential service provider is absolutely crucial to understanding their formidable competitive edge and why they stand out in what is often a very crowded and fragmented market. They've moved beyond just providing components to actively providing solutions that drive tangible efficiency and cost savings for their customers.
And this philosophy they have close to the customer, it's not just a marketing slogan for them, is it?
No, not at all.
It seems to be a fundamental, almost foundational principle that manifests in a very particular, tangible way. It really seems to set them apart from many traditional distributors. How does this concept actually play out in their strategy?
You're absolutely right. It's far more than a slogan. It's core to their DNA. The basic idea is about creating physical proximity and delivering an incredibly high-touch, responsive service experience.
Okay.
Now, in their earlier days, this meant opening a vast network of many smaller physical branches spread across the country. The goal was to have a Fastenal store just minutes away from any potential industrial customer.
Makes sense. Convenience.
Right. But the truly significant evolution, the real game changer in recent years, has been their pivot to what they call on-site locations. Yes. And this represents a much deeper, more sophisticated interpretation of that close to the customer philosophy.
So an on-site location isn't just another Fastenal store, like a public-facing branch we might see. What exactly does it entail? Is it literally like a Fastenal operation set up inside a customer's own factory or facility?
That's precisely what it is. It's essentially having a dedicated Fastenal team and a mini warehouse, a dedicated inventory stock right there within the customer's factory or operational site.
Wow, okay.
And this model offers several distinct advantages that are central to their strategy. First, it enables deep integration into the customer's daily workflows.
Up so.
Well, the Fastenal team understands the customer's specific production lines, their critical needs, they see what's happening day to day, they can respond to issues or fulfill requests almost instantly because they're right there.
Okay, that makes sense. Immediate response.
Exactly. Second, these on-sites secure significant and remarkably consistent revenue from a single customer relationship. They often end up managing a substantial portion of that customer's entire MRO maintenance, repair, and operations spend.
So big, stable contracts.
Very stable. But perhaps most importantly, it creates incredibly high customer switching costs.
Ah, the stickiness factor.
Precisely. Imagine the logistical nightmare, the operational disruption, the sheer effort involved in unwinding that deeply embedded service and bringing in a new supplier once Fastenal is fully operating and on-site within your walls.
Yeah, ripping that out sounds painful.
It makes Fastenal an integral part of their operations, not just a vendor.
So they've really transitioned from being a supplier you simply call when you need something to becoming, well, almost an indispensable part of your operational infrastructure. Like part of the furniture, so to speak.
Exactly. That's a great way to put it. This model doesn't just sell products. It secures large, recurring revenue streams without the substantial capital outlay required for building a new public branch that serves multiple, less predictable customers.
More capital efficient.
Highly capital efficient. It's a smart way to become truly indispensable, transforming Fastenal from a potentially replaceable commodity supplier into a critical component of a customer's operational success.
Okay, so being physically embedded is a huge advantage. But as if that wasn't enough to construct this formidable competitive moat, they've layered on a sophisticated digital strategy. Tell us more about this digital footprint they refer to.
Yes, the digital footprint.
It sounds like a critical piece of their modern identity and their long-term advantage.
This is truly where Fastenal's innovation shines, and you're right, it's critical. The digital footprint is far more than just a basic e-commerce website, which, let's face it, many distributors now offer.
Table stakes now, almost.
Kind of. This is different. It's a sophisticated suite of technology-enabled services, meticulously designed to automate inventory management directly at the point of use within the customer's facility.
Okay, automation at the source.
Exactly. And the remarkable growth and pervasive adoption of this digital footprint serves as a direct proxy for the deepening and widening of their competitive moat. It's about leveraging technology to make their physical presence even more effective, even more efficient, and even more difficult to dislodge from a customer's operations.
So if I'm a factory manager listening to this, what does this digital footprint actually look like in practice? How does Fastenal's technology impact my day-to-day operations?
Right. It's all about enhancing automation and driving efficiency right there on the shop floor. The centerpiece is what they call FMI technology, which stands for Fastenal Managed Inventory.
FMI, okay.
And the most visible component of this is probably their fast-vend industrial vending machines.
Ah, the vending machines for tools and gloves and things.
Precisely. These are essentially highly specialized, secure vending machines that provide 247 access to high-use MRO items like safety gloves, eye protection, specific cutting tools, or critical fasteners right where they're needed most.
Super convenient for workers.
Absolutely. And these machines automatically track usage, they reorder when supplies run low, and they can even assign costs to specific departments or projects, which really helps streamline cost allocation.
So better cost control, too.
Definitely. But it's not just vending. Beyond that, they also offer fast-in and fast-stock systems.
Okay, what are those?
These utilize more advanced technologies, things like infrared sensors, sometimes weight scales, even RFID tags, to continuously monitor inventory levels of smaller parts stored in bins or on shelves.
This is for the tiny screws and washers and things.
Exactly. When levels drop below a preset threshold, the system automatically triggers a replenishment order. This completely eliminates the need for manual counts and, those cumbersome paper purchase orders.
Wow. So no more guessing if you have enough critical components in stock, or someone spending valuable time manually counting bins and then filling out purchase orders.
God.
It's all handled automatically by technology, freeing up personnel. That sounds like a massive time and cost saver for any manufacturing operation.
Exactly. It eliminates those labor-intensive, often error-prone manual processes. It allows the customer's team to focus squarely on their core production and value-added activities, not chasing down parts.
Right.
It creates a seamless, automated ecosystem for MRO procurement. And the digital footprint also extends to their broader e-business channels. This includes their transactional website for maybe less automated orders, but crucially integrated procurement systems like electronic data interchange or EDI.
EDI. What is it in simple terms?
For you listening, think of EDI as a direct digital pipeline. It allows a large customer's own enterprise resource planning, their ERP system, which is like the central brain for managing business processes.
Like SAP or Oracle.
Exactly. It allows that ERP system to talk directly and seamlessly with Fastenal systems. This automates the entire order-to-delivery process for those high-volume, critical items, removing pretty much all manual intervention.
And this digital footprint, this isn't some, like, experimental side project for them, is it? It's core.
Oh, absolutely core.
Our sources highlight that the digital footprint accounted for a massive 60.4% of Fastenal's total revenue in 2024.
60.4%, yeah.
Which is a significant jump from 49.3% just back in 2022.
Yeah.
And they're not stopping there. They're targeting between 66% and 68% for 2025.
Incredible growth trajectory.
That's just phenomenal growth for a company that, started with physical fasteners.
That growth is truly phenomenal and absolutely critical to their long-term strategic vision. Think about it. When a customer integrates these FMI systems, they are essentially outsourcing their internal procurement and inventory management functions to Fastenal's automated ecosystem.
Handing it over.
Pretty much. And this creates a powerful flywheel effect. The technology makes the customer's operations more efficient, which deepens their reliance on Fastenal, which in turn funnels a recurring and growing stream of product sales through those systems.
It feeds itself.
Exactly. And the process of removing this deeply embedded infrastructure, re-engineering internal workflows to accommodate a different supplier, it's a significant, often prohibitive barrier to switching.
Huge hassle factor.
It's a very smart, incredibly sticky play that insulates a large and growing portion of Fastenal's revenue from simple price-based competition. It's effectively widening their competitive moat with every installation.
So for any business owner or operations manager listening right now, this tells a clear story. You're not just looking for a good price on a box of bolts anymore.
Not if you want to be efficient.
You're looking for operational efficiency, absolute reliability to avoid costly downtime, and seamless integration that frees up your team. Fastenal, through its on-sites and digital footprint, seems to have figured out how to wrap all of that into one highly integrated and incredibly difficult-to-leave package. Let's shift gears a bit. Let's talk about what they actually sell now. We know fasteners were their bread and butter, their starting point, but that's been changing quite a bit, right?
Definitely changing.
Their product mix is much broader now, moving well beyond just holding things together.
Yes. Their product portfolio has become truly extensive. It covers a very wide range of maintenance, repair, and operations, or MRO supplies.
MRO, okay.
And while fasteners remain foundational to their identity, they accounted for about 30.4% of net sales in Q3 2025. So still significant, but their share is definitely declining as the company strategically diversifies its offerings.
Down from what, historically? Much higher.
Oh, much higher. Decades ago, it would have been the vast majority. This diversification isn't accidental. It's a deliberate part of their evolution to become that comprehensive MRO partner.
So if fasteners are becoming a smaller slice of the pie, what product categories are stepping up to take their place? What are the significant growth areas within their portfolio these days?
Safety supplies have emerged as a particularly strong growth driver. They reached 22.1% of sales in Q3 2025.
Safety. So gloves, glasses.
Exactly. This category includes everything from essential personal protective equipment like gloves and hard hats to eye protection, earplugs, respiratory protection, fall protection, various safety signage, all crucial for maintaining workplace safety and compliance.
Which is huge for manufacturers.
Absolutely non-negotiable. And then the largest and most diverse category is what they broadly term other product lines, which hit a substantial 47.5% of sales in Q3 2025.
Almost half the business.
Almost half. And this is really a catch-all for a vast array of MRO products. Think general hand tools, specialized cutting tools, abrasives, electrical supplies like conduit and wiring, janitorial and sanitation items, chemicals, hydraulics, pneumatics, even things like office supplies in some cases.
Wow, it's a huge range.
It truly showcases their transition to a broadline MRO supplier capable of meeting almost any industrial customer's day-to-day needs.
That level of diversification makes a lot of strategic sense.
Yeah.
It reduces dependence on the highly cyclical fastener market, right? When manufacturing activity slows, fastener demand might drop sharply, but maybe safety supplies or janitorial items remain more stable.
That's the theory, yes. Smooths out the cyclicality somewhat.
However, here's where it gets really interesting. Our sources highlight that this very diversification is also a primary contributor to a structural shift in the company's margin profile.
Ah, the margin question, yes.
What exactly does that mean for Fastenal's financial performance and for us as observers trying to understand the business?
This point is critical, and it signifies a deliberate strategic trade-off they're making. These broader MRO categories, things like safety and janitorial supplies, while opening up vast new markets and sales opportunities.
Which they clearly are.
Right. But they typically carry lower gross margins than the more specialized, sometimes proprietary fasteners Fastenal historically focused on.
Okay, so less profit per item sold, percentage-wise.
Percentage-wise, exactly. So while they are successfully gaining significant market share and growing absolute profit dollars by selling more of these items, the percentage gross margin on their consolidated sales can and has come under pressure.
Got it.
This is a conscious decision management is making, prioritizing expansion, deepening those customer relationships through on-sites and broader offerings, and increasing overall revenue and absolute profit dollars, even if it means accepting a slightly lower gross margin percentage.
Trading margin percentage for volume and stickiness.
Precisely. It's a classic example of that trade-off. They believe the long-term value of the integrated relationship outweighs the short-term impact on the gross margin percentage.
They're not just relying on their digital prowess or their on-site teams, though. Underlying all of this, they've got a massive physical distribution network that is truly the backbone of their entire operation, isn't it?
Absolutely critical.
How does that intricate system function to support their strategy?
Absolutely. You can't deliver that level of service without world-class logistics. It's a highly sophisticated hub-and-spoke model that underpins their entire service delivery.
Hub and spoke.
At the heart of it are 14 large distribution centers strategically located across North America, 11 in the U.S., 2 in Canada, and 1 in Mexico.
14 huge DCs.
Yeah, and these aren't just mere warehouses. They are highly efficient logistical hubs, increasingly equipped with advanced automation. Fastenal is continually investing in this infrastructure. For example, they recently completed a new replacement hub in Utah and commenced construction on another new, highly automated hub in Atlanta.
Investing heavily in logistics.
Constantly, this expands capacity, enhances automated picking capabilities, and ultimately shortens delivery times to their branches and on-sites. This scale and ongoing investment in their logistical backbone represent a significant, difficult-to-replicate competitive advantage. It ensures product availability and reliable, rapid delivery.
And how do those on-site locations we talked about earlier, those mini branches inside customer facilities, how do they fit into this hub and spoke model? Are they just receiving direct shipments from the nearest big hub?
Precisely. The on-sites act as the critical spokes that extend deep into the customer's operations. They are directly supplied by these major distribution centers, usually on a daily basis via Fastenal's own truck fleet. This ensures that the specific inventory needs of an embedded on-site are met efficiently and accurately.
Okay.
And in fact, the growth of on-site signings has become a far more critical key performance indicator, or KPI, for Fastenal than the number of new public branches they open.
Really? More important than new stores?
Yes. This clearly signals their strategic shift towards deep customer integration, rather than simply expanding a broad, retail-like store footprint. It's a testament to the power they see in their integrated service model.
Let's really drill down into the digital footprint numbers again, because they tell such an astonishing story of transformation. Our sources tell us FMI sales alone, that's Fastenal Managed Inventory, through vending and smart bins, represented an incredible 42.5% of total company sales in 2024.
Almost half the business flowing through automated systems.
It's amazing. And they didn't just maintain that. They signed almost 28,000 new FMI devices last year, growing their installed base by over 12% to nearly 127,000 MEUs, or machine equivalent units.
They use MEUs to standardize the capacity of different devices, yeah.
Okay, so what does this massive deployment and adoption actually mean for both the customer and for Fastenal's bottom line?
It means that a very large and rapidly growing portion of Fastenal's revenue is now funneled through automated self-replenishing systems embedded directly in customer facilities.
Right there on the factory floor.
Exactly. For the customer, it's a seamless set-it-and-forget-it solution. It eliminates manual inventory checks, drastically reduces costly stockouts of critical items, and ensures they always have the parts and supplies they need right at the point of use without any administrative burden.
Huge efficiency gain for them.
Huge. And for Fastenal, this translates into exceptionally sticky, recurring revenue streams. The relationship fundamentally transforms from purely transactional, I need this, you sell it to me, to truly symbiotic.
Symbiotic, interesting.
Yeah, where Fastenal's technology becomes an indispensable, highly valued part of the customer's operational efficiency and cost control strategy. They need it to run smoothly.
It's a brilliant strategy, really. Their technology creates this sticky web that removes the hassle of procurement for customers. And once that hassle is gone, once you've integrated that deeply, why would any company ever want to go back to the old, less efficient ways? It just seems unlikely.
Very unlikely. The switching costs are just too high, not just financially, but operationally.
Now, this industrial distribution market we're talking about sounds absolutely colossal, but how big are we talking, really? Give us some perspective on the sheer scale of the global industrial supply world.
You're right to emphasize the scale. It's almost mind-boggling. What's truly fascinating here is just how vast and essential this market is. Globally, the industrial distribution market is estimated to be worth over $8 trillion.
$8 trillion.
Yeah. With the U.S. market alone pegged at approximately $2.9 trillion in 2024.
Okay, still huge.
And if we narrow it down further to the North American MRO distribution market, where Fastenal directly competes most intensely, that was valued at over $160 billion in 2024.
$160 billion just for MRO in North America.
Correct. And projections indicate steady, albeit modest, growth in the coming years, generally around 2.5% to 5% compound annual growth rate, or CAGR. So we're talking about a massive, absolutely foundational industry that powers nearly everything around us.
That's an enormous pie. But what's the most critical characteristic of this colossal market? Because I can imagine there are countless players trying to get a slice, from tiny local mom-and-pop shops to global giants like Fastenal.
The most critical characteristic, and really a key insight for understanding Fastenal's success and opportunity, is its extreme fragmentation.
Fragmentation, meaning lots of small players.
Exactly. Our sources indicate that the top 50 distributors combined account for only about a third of the total market, maybe even less in some estimates.
Only a third.
Yeah. This means the landscape is populated by literally thousands of smaller local and regional players. And these smaller players often lack the scale, the technology, the purchasing power, and the sophisticated logistical capabilities of larger competitors like Fastenal or Grainger.
Right. They can't invest in the same way.
Precisely. And this fragmentation is absolutely key because it provides large, sophisticated players like Fastenal with a very long runway to grow simply by systematically consolidating market share. Even in a mature economic environment where overall market growth might be modest, they can grow significantly faster just by taking share from these less efficient players.
So growth comes from taking share, not just the market growing.
A huge part of it, yes.
Yeah.
Especially in a fragmented market like this.
So it's clearly not a stagnant market, despite its maturity. What are the big secular trends, those long-term, powerful forces that are currently reshaping this industry, and perhaps playing directly into Fastenal's strengths?
Yeah, there are three main trends that are truly driving significant change, and you're right, playing directly into Fastenal's strategic advantages. First, there's the relentless push for digitalization and e-commerce.
We see that everywhere.
Exactly. Industrial customers are increasingly demanding faster, more efficient digital procurement channels, forcing distributors to invest heavily in robust e-commerce platforms and integrated digital solutions. If you don't have it, you're falling behind.
Okay, trend one, digital.
Trend two, supply chain resilience and efficiency. This has become paramount, especially post-pandemic.
Oh, yeah. Everyone felt that pain.
Right. Businesses are placing a much higher value on reliability, inventory availability, and efficient, often just-in-time delivery models. They want partners they can count on. This trend strongly favors distributors with sophisticated, robust logistics networks like Fastenal's.
Reliability is key. What's the third trend?
The third is the widespread adoption of automation and IoT, the Internet of Things, on the factory floor.
Industry 4.0.
Exactly. The evolution towards Industry 4.0 technologies is creating a direct, growing demand for distributors who can provide automated inventory solutions, like those vending machines and smart bins we talked about, that integrate seamlessly with these modern production systems.
So their tech fits right in.
Perfectly. Fastenal's entire strategic playbook, on-sites, digital footprint, logistics is perfectly aligned with, and indeed capitalizing on, these powerful secular trends.
You've consistently mentioned Fastenal's competitive moat. Can we unpack that a bit more? How exactly has Fastenal managed to construct such a strong and crucially sustainable one in a market that's both massive and incredibly fragmented? It sounds like it's built on more than just one thing.
You've hit on it. It's definitely not just one thing. It's a combination of mutually reinforcing advantages, essentially a multi-layered defense that makes them incredibly difficult to dislodge.
Okay, layer one.
First, there's their immense logistical scale. We talked about the 14 North American distribution hubs, their private fleet of over 650 semi-trucks, and their massive inventory holding over $1 billion worth. This creates an operational backbone that ensures unparalleled product availability and reliable delivery at a scale very few competitors can match.
Scale matters. Layer two.
Second, it's their service intensity. The on-site model provides that level of customized, on-the-ground service and relationship building that pure e-commerce players or distributors relying on centralized call centers simply cannot replicate. They're solving customer problems in real time, right where they happen, building trust.
The human touch, integrated.
Exactly. And third, and arguably the most powerful layer now, is their technological integration.
The digital footprint again.
Yes. As we've discussed, the digital footprint creates exceptionally high switching costs by embedding their technology and processes directly into customer facilities. Once those fast vend machines are installed, once the bins are set up, once it's linked to a customer's ERP system via EDI, it becomes a monumental undertaking, both logistically and financially, to rip all that out and start over with a new supplier.
Locked in almost.
Pretty close to it.
So it's not just one of these elements alone, not just the trucks, not just the on-site staff, not just the vending machines, but the powerful synergy of the physical logistics, the human service touch, and the digital automation all working together in concert. That's what really makes their competitive position so robust and hard to replicate.
Precisely. You nailed it. The logistical network enables the high service levels required by the on-site model, and the technology platform automates and scales the benefits of that close physical relationship. These aren't isolated strengths. They're deeply interwoven, creating a formidable and genuinely difficult to replicate competitive barrier that actually grows stronger and wider with each new on-site signing and FMI installation.
Let's put Fastenal in context now. Who are their main rivals in this vast industrial distribution space? And how do their strategies and, importantly, their financial performances stack up against Fastenal's?
Good question. Their primary publicly traded peers offer some very interesting comparisons because each approaches this market with a slightly different strategy. The biggest player, and often seen as their most direct, large competitor, is W.W. Grainger, GW.
Grainger. Yeah, big name.
Huge. They did $17.2 billion in 2024 revenue. Grainger actually employs a bifurcated strategy, which is interesting. They have a high-touch solutions segment for large, complex customers, which sounds quite similar to Fastenal's on-site model, providing tailored, value-added services.
Okay, similar there.
But they also have an endless assortment segment, primarily through their Zoro.com platform, which targets smaller, often web-only customers with a more streamlined, transaction-based approach. Lower touch, wider selection.
So two different approaches under one roof.
Exactly. This contrasts with Fastenal's more unified, deeply integrated service model focused primarily on that high-touch embedded relationship. Then there's MSC Industrial Direct, MSM. They have around $4.0 billion in annual revenue. MSC historically specialized in the metalworking and machine shop segment, so they brought deep technical expertise to that specific niche.
Metalworking specialists.
Traditionally, yes. However, recognizing the success of integrated supply models like Fastenal's, MSC is now aggressively pursuing its own mission-critical strategy. They're trying to expand into high-touch solutions, including vending and in-plant programs, to broaden their reach.
So they're moving on to Fastenal's turf.
They're certainly trying to compete more directly in those core growth areas, yeah. It shows how the market is kind of converging on these embedded value-added solutions. And finally, a third significant peer is Applied Industrial Technologies, AIT. They had around $4.5 billion in fiscal 2024 sales. AIT is a value-added distributor, but they focus more on technical and engineered product categories.
Like what?
Things like bearings, power transmission components, fluid power systems, advanced automation solutions. While they serve the same broad MRO and OEM customer base, their product specialization is different from Fastenal's fastener and general MRO focus.
More technical products.
Exactly. It makes AIT more of a complementary peer in some ways, rather than a direct head-to-head competitor across all product lines. They often focus on higher value, more technically complex components where specialized engineering expertise is key.
Okay, so while they all operate in the same vast sandbox of industrial distribution, they're clearly approaching it with somewhat different strategies and focusing on distinct aspects of the customer relationship or product category. But what does the data tell us about their financial performance compared to Fastenal? Does Fastenal's highly differentiated strategy actually translate into better numbers on the income statement and balance sheet?
That's the key question, right? Does the strategy pay off financially? And if we look at Table 1, competitive benchmarking from our sources, the numbers are quite telling. Fastenal consistently demonstrates strong profitability metrics relative to these peers.
How strong?
Well, for instance, Fastenal boasts a gross margin of 45.1% and an operating margin of 20.0% based on recent data. These figures are generally higher than W. Grainger's, which reported a 39.0% gross margin and a 15.4% operating margin.
Noticeably higher.
Yes, and also higher than MSC Industrial's 40.7% gross margin and its much lower 8.0% operating margin based on adjusted figures from their Q1 Foot 25.
Okay, big difference with MSC's operating margin.
Right. This higher profitability for Fastenal indicates the efficiency of their deeply integrated model and suggests significant pricing power, likely stemming from those deep customer relationships and the high switching costs created by the on-site and digital footprint strategy.
So the strategy seems to provide a clear operational advantage.
The operational metrics certainly suggest so. However, as we'll definitely get into, while the operational performance is strong, the valuation the market puts on that performance is another story entirely.
Yeah, that's a crucial distinction. But for anyone trying to understand the competitive dynamics of this industry, this comparison really highlights why Fastenal's strategy of deep technological integration isn't just unique. It seems to be a powerful playbook in a market that, despite its massive size, remains incredibly fragmented and ripe for consolidation by sophisticated players like them. Now, let's turn our attention squarely to the financial blueprint of Fastenal. Their performance over the past few years tells a truly interesting story of growth against what has been, frankly, a challenging macroeconomic backdrop for industrial companies. Our sources specifically mention a period of slowing growth from 2022 to 2024. What happened during that time?
Right, the growth story moderated significantly during that period. Net sales grew only a modest 2.7% in 2024 to $7.55 billion.
Only 2.7%. That's quite slow for them, isn't it?
It is, especially compared to prior years. It was a sharp deceleration. And if you look at it on a daily sales basis, which adjusts for the number of business days in the period, growth slowed to just 1.9% in 2024.
Wow.
And this slowdown was a direct reflection of a cooling industrial environment. Their end markets, manufacturing and construction, are inherently cyclical and sensitive to broader economic conditions.
And our sources mention something interesting here, that this slowdown was actually accurately predicted by the Purchasing Managers Index, or PMI. Can you tell us what the PMI is and why it's so relevant for Fastenal?
Yes, that's right. The company's leadership explicitly noted this connection in their reports and calls. The slowdown they experienced was very much in line with what the PMI was signaling at the time.
Okay, so what is the PMI?
For you listening, the Purchasing Managers Index, PMI, is a really critical barometer for the health of the manufacturing sector. It's based on surveys of purchasing managers. A reading above 50 generally indicates expansion in manufacturing activity, while a reading below 50 suggests contraction.
50 is the magic number.
Exactly. And when the PMI started to signal an industrial contraction beginning in late 2022 and persisting through much of 2023 and into 2024, Fastenal's sales trends followed suit quite closely.
A leading indicator for them.
It really underscores just how sensitive Fastenal's performance is to the broader health of the industrial economy. When manufacturing slows down, so does demand for MRO supplies. It's a direct correlation.
But then there's a more recent update. The second quarter of 2025 showed a reacceleration. Sales growth picked back up to an impressive 8.6%.
Yes, a welcome rebound.
So what does this reacceleration really mean in the context of what you just told us about the PMI link? Is the industrial economy suddenly roaring back to life, or is something else driving that improvement?
That reacceleration in Q2 2025 is certainly positive news, but the story is a bit nuanced. Management indicated it was primarily driven by strong performance from their existing contract customers, particularly those with on-site locations and national accounts.
So the big embedded customers.
Exactly. While this indicates success in penetrating those accounts and taking more share of their spend, management actually cautioned that the underlying market conditions, the broader industrial economy, remained somewhat sluggish or mixed.
Ah, okay. So it wasn't just a rising tide lifting all boats.
Not entirely. What it strongly suggests is that Fastenal is successfully continuing to gain market share through new on-site and national account signings and deepening relationships with existing ones, even in what is still a somewhat weak industrial tide. They're effectively swimming against that tide, but steadily gaining ground by taking business from less efficient competitors, rather than simply benefiting from a broad market rebound. It speaks to the strength of their model.
And geographically, where's the money coming from? Are they still heavily concentrated in their home market, the U.S., or are they seeing more international growth pick up?
The business remains very heavily concentrated in North America. In 2024, the United States accounted for a substantial 83.1% of total revenue.
Over 80% just from the U.S.
Yep. With Canada and Mexico adding another 13.7% combined, international markets outside of North America make up a much smaller, though gradually growing portion, around 3-4%.
So huge potential internationally still.
Absolutely. It indicates significant long-term expansion potential there as they look for new growth vectors. And as we discussed, the product mix also continues its shift away from fasteners, which you can see clearly detailed in Table 3 from our sources, now less than a third of sales. This geographic and product concentration provides both stability from their core market, but also that clear avenue for future international expansion.
Now for the margins, this is where that strategic product mix shift we discussed earlier becomes really clear in the financial data. It reflects those deliberate trade-offs between growth and profitability percentage.
Absolutely. This is where you really see the impact of that strategic choice. Their consolidated gross margin has actually declined sequentially over the past 3 years. It fell from 46.1% in 2022 down to 45.7% in 2023, and then further to 45.1% in 2024.
A full percentage point drop in 2 years.
Yes. And the 2024 annual report directly attributes this compression to an unfavorable customer and product mix.
They spell it out.
They do. As Fastenal successfully executes its strategy of signing those large on-site customers and increasing sales of non-fastener products, like safety and general MRO, it is structurally shifting its revenue base towards business that, while attractive in absolute dollar terms and highly sticky,
Right, the goal.
it carries a slightly lower gross margin percentage compared to their traditional, often more specialized fastener business. It's a deliberate, strategic decision with clear financial consequences on that specific metric.
So they're consciously making that trade-off, accepting a slightly lower percentage margin for greater market share and ultimately higher absolute profit dollars over the long term. That's the plan, but it also impacted their operating margin too, didn't it? Especially when sales growth slowed down like it did in 2024.
It certainly did. That's the downstream effect. After holding remarkably steady at 20.8% in both 2022 and 2023, which is a very high operating margin for a distributor.
Sure, industry leading, right.
Generally, yes, but it contracted to 20.0% in 2024.
Okay, it dropped there too.
And this was a direct result of what we call negative operating leverage. Essentially, their selling, general, and administrative expenses, their SG&A.
The overhead costs.
Right. SG&A grew by 3.6% in 2024, which actually outpaced their more modest 2.7% sales growth. Management explained this by noting their unwavering commitment to continued investment in key growth areas, things like personnel for those on-site locations, and the development and deployment of more FMI technology, even as sales growth moderated due to the challenging macroeconomic environment.
So they didn't cut back on investment when sales slowed.
No, they kept investing for the long term.
So they're unequivocally playing the long game here. They're prioritizing foundational investments in strengthening their competitive moat over achieving short-term margin optimization, even if it means a temporary dip in those profitability ratios.
That's precisely the strategic trade-off playing out in the numbers. They're prioritizing long-term market share capture and the expansion of their competitive moat. The core challenge stemming from this strategy, looking forward, is generating enough operating efficiencies and scale benefits from these larger, more integrated customer relationships to eventually offset that structural decline in the gross margin percentage.
Can the efficiencies catch up?
That's the key question. The 2024 results indicate that this point of positive leverage, where SG&A grows slower than revenue again, has not yet been fully reached. So, achieving SG&A discipline and realizing those hoped-for on-site efficiencies becomes a critical factor for future profitability expansion.
How are they managing their cash flow and working capital, like inventory, through all these strategic shifts and the macroeconomic ups and downs. Because inventory, in particular, can really tie up a lot of capital for a distributor and impact liquidity.
Yeah, working capital management is crucial. And Fastenal's approach here has been quite dynamic, reflecting the changing supply chain and demand environment we've seen recently. In 2023, for instance, they generated significant cash simply by reducing their inventory balance. They cut it by over $185 million, which was a 10.8% decrease.
Why did they do that?
Primarily because global supply chains were normalizing after all the disruptions from the prior years. They didn't need to hold as much safety stock. It was a smart move to free up capital.
Okay.
However, in 2024, this trend reversed. They actually increased inventories quite substantially by over $122 million, which was an 8.0% increase.
So they build inventory back up.
Yes, and this build was described as a proactive measure. It was primarily to support anticipated sales growth in 2025, to improve service levels at their distribution hubs, and also to capitalize on some favorable year-end purchasing opportunities from suppliers.
Got it. And receivables.
Accounts receivable growth moderated along with sales, increasing by just 1.9% in 2024. That's a positive sign for efficient cash conversion from their sales.
Okay, so despite all these pressures, the slowing growth for a period, the margin compression, the inventory build in 2024, the company is still, fundamentally, a cash-generating machine. How resilient is their business model in this regard, especially when facing those industrial headwinds?
This is a crucial question for understanding the underlying financial health of the business, and the answer is very resilient. Even with the cyclical slowdown and those significant strategic investments we've talked about, Fastenal's business model remains exceptionally cash generative.
How much cash are we talking?
Net cash from operating activities was robust, totaling $1.17 billion in 2024, and free cash flow, which basically operating cash flow minus capital expenditures.
Cash left over after investments.
Exactly. Free cash flow was around $959 million in 2024. Now, while this figure was down from the exceptional $1.27 billion generated in 2023, a year that was somewhat inflated by that large inventory reduction we just discussed.
Right. The inventory sell-down boosted cash that year.
Correct. But nearly $1 billion in free cash flow in 2024 is still a very strong performance. It really highlights the underlying financial strength and resilience of their operating model. It demonstrates they have ample capacity to fund both internal investments and shareholder returns, even during periods of industrial weakness and active reinvestment. It's a testament to the quality of their business.
So they've got this impressive, resilient cash flow, even in tougher times. How does management actually choose to use all that cash? What's their established capital allocation strategy? What are the priorities?
Management has articulated a very clear and disciplined capital allocation hierarchy. The first priority always is to fund organic growth.
Reinvest in the business first.
Absolutely. This includes essential investments in working capital, like the inventory and receivables needed to support sales, and crucially, capital expenditures, or CapEx. This CapEx is primarily for expanding on-site locations and deploying more of that FMI hardware, the vending machines and bins.
Investing in the core strategy.
Exactly. For example, net CapEx is guided to increase significantly to a range of $265 million to $285 million in 2025. That's a substantial step up from the $214.1 million spent in 2024.
Where's that extra money going?
It's specifically targeted at those core growth drivers, elevated IT spending to enhance their digital footprint capabilities, investments in distribution center capacity and automation, like that new Atlanta hub, and higher outlays for acquiring and deploying more of those FMI devices.
Okay, so internal growth is priority number one. After they've funded all that critical investment, what's next in their priorities for that significant cash flow? Is it about returning capital to shareholders?
Yes. Precisely. The second priority is returning capital to shareholders, and they do this primarily through dividends.
Dividends.
Yes. Fastenal has an incredibly long and reliable track record here. They've paid a dividend every single year since 1991, and they've paid it on a consistent quarterly basis since 2011.
Very consistent.
Very. They also periodically issue special one-time dividends when cash builds up, with the most recent being in December 2023. In 2024, they paid total dividends amounting to $1.56 per share.
Okay. What about share buybacks?
Share repurchases are considered a secondary tool for returning capital. They're often used just to offset dilution from employee stock option grants, or perhaps opportunistically if management perceives the stock to be significantly undervalued. However, it's very notable that they did not repurchase any stock in either 2023 or 2024.
No buybacks recently. Why not?
This pause strongly signals management's current view. They likely believe that reinvesting that capital directly back into the business, given the growth opportunities they see in on-site and FMI, and considering the stock's current high valuation, offers a superior long-term return compared to buying back shares at these levels. It shows discipline.
That makes sense.
Yeah.
So for anyone observing Fastenal's financial movements and capital allocation, this tells a story of a company confidently investing in its future growth engines and strengthening its moat, even when macro conditions are tough. And at the same time, being highly disciplined and thoughtful with its significant cash generation, prioritizing dividends over buybacks at the current valuation. Let's look ahead now. What exactly is driving Fastenal's growth going forward? Is it simply a matter of riding the broader economic wave, hoping for a manufacturing rebound? Or do they possess their own powerful internal engines for continued expansion, perhaps somewhat independent of the macro environment?
It's much more the latter. While a strong economy certainly helps, their growth strategy isn't primarily reliant on just riding the economic wave. It's overwhelmingly focused on organic expansion.
Organic, meaning not through acquisitions.
Primarily, yes. It's about deepening their penetration within existing markets, leveraging their unique service model to consistently gain market share from competitors, and expanding into new customer types and verticals. They have a clear, repeatable algorithm for growth that isn't solely reliant on a booming industrial economy. It's much more about strategic execution of their unique model.
So we should expect to see even more on-site locations being signed up then. That seems to be a major ongoing part of their core strategy.
Yes, on-site penetration remains their foremost growth priority. And they're also demonstrating the model's remarkable adaptability by successfully expanding beyond their traditional base in heavy manufacturing.
Where else are they going?
For instance, in Q2 2025, revenue from non-manufacturing sites, think customers in construction, warehousing, government agencies, hospitals, even utilities, that were generating over $50,000 per month in revenue grew by an impressive 30% year over year.
30% growth in non-manufacturing.
Yeah, and the number of such large non-manufacturing sites increased by over 18%. This clearly shows the model's versatility and its applicability to a much wider range of end markets than just factories, significantly expanding their total addressable opportunity.
And the FMI, those vending machines and smart bins, they're still a huge part of the plan too, clearly. That number just keeps growing.
Absolutely. The continued deployment of FastVend and FastBin systems remains critical to their growth strategy. Remember, these technologies automate replenishment and essentially lock in customers, making them incredibly sticky.
Right, the switching costs.
Exactly. They've set an ambitious goal of signing between 28,000 to 30,000 new MEUs, machine equivalent units, in 2025. That's actually an increase from their 2024 target.
Upping the target even further.
Yes, which reflects strong ongoing customer demand and management's confidence in the continued long runway for this technology. And just to put that runway in perspective, our sources indicate the potential North American market alone could eventually support as many as 1.7 million industrial vending units.
1.7 million, compared to what they have now.
Compared to their current installed base of just over 125,000.
Wow. That is a vast, largely untapped opportunity for further penetration and market share capture just with that one technology. Are there any other growth avenues they're actively exploring beyond just expanding on-sites and FMI within North America? Any other levers they can pull?
Yes, several other vectors offer substantial long-term expansion opportunities. While currently representing only about 17% of total revenue, including Canada and Mexico, their international markets provide a huge long-term growth avenue, particularly in Canada and Mexico where they already have a strong presence, but also potentially further afield as Fastenal looks to export its successful integrated service model to new geographies over time.
Okay, international is one. What else?
They're also intensely focused on product and service expansion. This means continually broadening their product lines beyond fasteners into more MRO categories to create more cross-selling opportunities within their established on-site and FMI customer base. They're also offering more value-added services like tool repair, safety consulting, and even specialized training programs for customers.
Selling more stuff and services to existing customers.
Exactly, deepening the relationship. And of course, technological innovation remains paramount. Continued investment in their digital footprint platform, potentially including the future integration of advanced analytics, maybe using AI for more precise demand forecasting, and enhancing their e-business capabilities will be critical for driving further efficiencies for both Fastenal and its customers, and solidifying its technological advantage over the competition.
Okay, here's where the rubber meets the road for many investors, the part that often causes the most debate. We've painted a picture of a really strong, innovative company with a powerful competitive moat and clear growth engines. But is all of that every single strategic advantage, every future growth opportunity already reflected, maybe even over-reflected, in the stock price? What does its valuation look like compared to its fundamentals and its peers? This is often the elephant in the room for anyone considering an investment, right?
This is indeed the central analytical challenge for investors, and it's a critical point for you, our listener, to understand. Fastenal trades at a significant premium valuation, and it's a premium that has been quite persistent, but it's also much higher now than its historical averages.
How high are we talking?
As of August 2025, its trailing 12-month, or TTM, price-to-earnings ratio, the PE ratio, stood at approximately 48x.
48 times earnings. That sounds high for an industrial distributor.
It is objectively high. For anyone unfamiliar, a PE ratio tells you how much investors are willing to pay for every dollar of a company's annual earnings. So for Fastenal, investors are currently willing to pay $48 for every dollar of its trailing annual earnings. That's quite a premium baked in.
48 times earnings. How does that compare historically for Fastenal itself? Has it always traded at such elevated multiples, or is this a more recent phenomenon?
It's substantially higher than its own 10-year historical average PE, which is around 28.5x, so almost double the average PE of the last decade.
Wow.
Similarly, its TTM enterprise value to EBITDA ratio, EBITDA, was approximately 32.3x. That's also at the high end of its historical range.
What's EBIT again?
It's another common valuation metric. It basically compares the total value of a company, its market cap plus debt minus cash, to its earnings before interest, taxes, depreciation, and amortization. It's often seen as a cleaner measure for comparing companies with different capital structures.
Got it. So both PE and EBITDA are historically high.
Yes. What this tells us is that investors are currently paying a significantly higher price for each dollar of Fastenal's earnings, or EBITDA, than they have on average over the past decade. The market sentiment has clearly shifted, assigning a much greater value to its business model today than in the past.
And how about its direct competitors? Are Grainger and MSC Industrial trading at similar premiums, or does Fastenal really stand out even compared to them?
The premium is even more pronounced when you compare it directly to its primary competitors. W.W. Grainger, MSC Industrial Direct, and Applied Industrial Technologies, they all trade at PE ratios in the more modest 25x to 26x range.
Okay, so around half of Fastenal's PE.
Roughly, yes. And on an EBITDA basis, these peers are trading around 13x to 19x. Compare that to Fastenal's multiple, which is over 30x.
So, doing the quick math, Fastenal is valued at roughly an 80% to 90% premium over its direct competitors on a PE basis, and a similar or even larger premium on EBITDA. That's a huge gap. For us as observers, what does this all mean? What fundamental factors explain this significant premium that the market is willing to pay for Fastenal?
Yeah.
Why is it valued so much higher?
That's the million-dollar question, or perhaps billion-dollar question given its market cap.
Mm-hmm.
The market assigns this premium for several clear, fundamental reasons that we've discussed throughout this dive.
Like what? Summarize them for us.
Okay. First, it's perceived to have a superior business model. The on-site and FMI strategies truly create a stickier, more predictable, and more insulated revenue stream than a traditional distribution model, leading to what investors see as higher quality earnings.
Okay, better model.
Second, it boasts a wider competitive moat. Those high switching costs associated with its digital footprint provide a more durable competitive advantage that is genuinely difficult for others to replicate or erode quickly.
Stronger defenses.
Third, Fastenal has historically generated higher returns on invested capital, or ROIC. This indicates a more efficient and effective use of capital in its growth initiative compared to peers.
More efficient use of money.
And finally, it has a long, proven track record of consistent growth, consistently taking market share and growing faster than the underlying industrial economy for many, many years. Investors value that consistency.
Okay, those are definitely compelling reasons. A better model, wider moat, higher returns, consistent growth. But does this combination of factors truly justify such a high price tag, that 80–90% premium over peers? Even for a fantastic business, that seems like a significant amount for investors to pay, implying enormous expectations.
This is the critical question, the crux of the investment debate for Fastenal. The current valuation truly embeds very high expectations for future growth and profitability. It essentially leaves little to no margin for error.
More room for mistakes.
Very little. If growth were to falter significantly, maybe due to a prolonged macroeconomic downturn that hits manufacturing harder than expected, or if profitability were to erode more rapidly than anticipated, perhaps from intensified competitive pressures or that unfavorable mix shift getting worse.
Then what?
Then there's a significant risk of what's called multiple contraction. This means the market would likely re-rate the stock, deciding it no longer deserves that high 48x PE or 32x EV/EBITDA multiple, and assign it a lower one closer to its peers or its historical average.
So the stock price could fall even if the business is okay.
Exactly. Multiple contraction can lead to significant share price underperformance, even if the underlying business itself remains fundamentally sound and profitable. Investors buying Fastenal today are explicitly betting on continued flawless execution and sustained above-average growth for years to come to justify that premium price.
Right, so for anyone looking at Fastenal as a business or an investment, this really highlights that even a fantastic business, one with a stellar strategy and impressive execution, can come with a challenging price tag. It drives home the point that it's not just about what a company does or how well it performs operationally, but what you pay for it that ultimately determines your investment outcome. Now, no business operates in a vacuum, and even great companies face risks. Our sources lay out several important risk considerations for Fastenal. What are the main headwinds or potential pitfalls that could potentially derail their impressive trajectory, or perhaps more immediately, challenge that premium valuation we just discussed?
You're right. Understanding the risks is crucial, especially with a high valuation. The most significant and immediate risk facing Fastenal is its inherent macroeconomic sensitivity.
The economy again.
Yes. Their end markets are predominantly in the manufacturing and non-residential construction sectors, which are cyclical by nature. They ebb and flow with the broader economy. A downturn, especially a prolonged recession in industrial production, would directly impact customer activity, their capital expenditure budgets, and therefore demand for MRO products.
We saw that in 2023, 2024.
Exactly. The company's recent performance clearly demonstrated this link, with sales growth slowing right alongside those contractionary readings from the PMI. A deep or prolonged recession would almost certainly lead to negative organic growth for Fastenal and put significant pressure on their profitability.
In that margin story we discussed earlier, the deliberate trade-off they're making for market share with lower margin products.
Yeah.
That's a risk too, right, if it doesn't play out exactly as management anticipates.
Yes, absolutely. The margin pressure from strategic mix shift is a persistent headwind and a key risk to monitor as they continue to successfully win those large volume on-site customers and expand sales of non-fastener products, which, as we established, typically carry lower gross margins. There's that structural decline in their consolidated gross margin percentage. The primary risk here is that Fastenal fails to generate sufficient operating leverage, enough cost savings and SG&A efficiencies from those larger on-site accounts to fully offset this gross margin pressure.
What happens if they don't?
If they don't, it could lead to a sustained erosion of their industry-leading operating margin, which could definitely disappoint the market and negatively impact future earnings expectations and that premium valuation.
What about competitors trying to catch up or even new players trying to disrupt the space? Is that a significant threat to Fastenal's moat?
Competitive and technological threats are very real and shouldn't be underestimated. Large, well-capitalized competitors like W.W. Grainger and MSC Industrial Direct are not standing still. They are investing heavily in their own value-added services and digital platforms, directly targeting Fastenal's core growth areas like on-site solutions and industrial vending.
So direct competition is heating up.
It is. This intensified competition in these lucrative markets could lead to pricing pressure over time, potentially slower market share gains for Fastenal than they've enjoyed historically, or force them to increase investment in sales and service resources just to defend their position. And while Fastenal's service-intensive model provides a strong defense against pure price players,
Right, the relationship matters.
there's always the lurking risk of disruption from large e-commerce players, maybe even Amazon business, who could potentially compete aggressively on price for the less complex, more transactional MRO business, forcing Fastenal to defend its share in those segments.
Are there any significant operational risks that could trip them up, maybe related to their global supply chain or workforce?
Absolutely. Operational and supply chain risks are numerous for any large distributor. Fastenal sources a significant portion of its products, especially fasteners, from Asia, particularly China and Taiwan.
Geopolitical risk there.
Definitely. This exposes them to potential disruptions from geopolitical tensions, changes in trade policy like tariffs or quotas, shipping delays, port congestion, or even public health crises that could impact manufacturing or transportation routes.
We've seen all of that recently.
Exactly. Additionally, fluctuations in raw material costs, think steel for fasteners, oil for plastics, and fuel energy prices and freight expenses can significantly impact their input costs. While they've historically managed these well through pricing and sourcing strategies, a period of rapid, sustained inflation could challenge their ability to pass on costs quickly enough to customers, potentially compressing margins.
And labor.
Labor is another key one. As a service-intensive business relying on people in branches, on-sites, and distribution centers, labor market challenges, difficulty in attracting and retaining qualified personnel, wage inflation could impact their service levels and drive up SG&A expenses, especially in a tight labor market.
And finally, of course, circling back to the elephant in the room that we just discussed in detail, the valuation risk itself.
Yes, it deserves to be listed as a distinct risk. Any failure by Fastenal to meet those lofty growth and profitability expectations embedded in its current stock price, whether that failure is due to cyclical factors, competitive pressures, margin issues, or simple execution-related missteps, could trigger that sharp contraction in the stock's valuation multiple we talked about.
The PE comes down.
Right. And that could lead to significant share price underperformance, even if the underlying business remains fundamentally sound and continues to execute reasonably well by normal standards. The market demands near perfection at Fastenal's current price, and that creates inherent risk.
Okay, so those are the potential storm clouds. But it's not all doom and gloom, of course.
No.
What could send the stock soaring? What are the potential positive catalysts that could drive Fastenal to outperform even those high current market expectations?
Good question. There are definitely potential catalysts for outperformance. The most obvious one would be a stronger than expected cyclical recovery in the industrial economy.
The macro tide turns positive.
Exactly. If we saw the PMI surge back up and stay elevated, that would provide a powerful tailwind to Fastenal's sales growth and could significantly improve their operating leverage as fixed costs get spread over more revenue. That would likely be very well received.
Yes.
We would also look for clear evidence of margin stabilization or even expansion. If they can demonstrate that they are successfully generating those operating efficiencies from their growing on-site network, effectively offsetting the ongoing gross margin pressure from the product mix shift.
Proving the model's leverage.
Right. That would be a huge positive catalyst, addressing a key investor concern. And third, an acceleration in on-site or FMI signings beyond their already ambitious targets would signal even faster than anticipated market share gains and reinforce the long-term growth narrative, potentially leading analysts to revise their earnings estimates upward.
Conversely, what would be the biggest red flags for underperformance? What are the potential negative catalysts that could lead to a disappointing outcome for the company, or, more specifically, its stock price, given the high bar?
On the flip side, catalysts for underperformance would primarily be the opposite of those points. A prolonged or deeper recession in U.S. manufacturing would be the biggest external threat. That would likely lead to negative organic sales growth and significant margin pressure, directly challenging the assumptions underpinning the stock's high valuations.
The macro turns sour again.
Yes. Internally, intensified competition in their core on-site and vending markets, leading to significant pricing pressure or noticeably slower market share gains, would also be a major concern, as it would suggest their moat isn't as wide or durable as perceived.
Competitors making real inroads.
Right. And crucially, as we've stressed, a multiple contraction simply because they fail to meet those very high growth and profitability expectations could be the most impactful catalyst for underperformance, even if the business itself remains fundamentally healthy. The market has set a high bar, and falling short, even slightly, could be costly for the stock price.
So for anyone evaluating this company, whether as an industry observer, a customer, or a potential investor, it really boils down to weighing these powerful forces carefully. Fastenal is undeniably a high-quality business with a unique and effective strategy. But like any investment, it comes with a unique set of challenges and opportunities, especially when the market has already baked in such high expectations into its current valuation. Wow, what an insightful journey that was into the intricate world of industrial distribution. We've really seen how Fastenal truly transformed itself, haven't we? From a basic fastener supplier
Still beginnings.
into this sophisticated, technology-driven logistics partner. They are now deeply embedded in their customers' operations through those vital on-site locations and their powerful digital footprint, those fast-vend industrial vending machines, and fast-bin automated inventory systems.
Yeah, and if we connect this to the bigger picture, their competitive moat built on that formidable combination of immense logistical scale, that high-touch service intensity from the on-site teams, and the advanced technological integration of the digital footprint, it's truly formidable.
Hard to replicate.
Very. And they're not just maintaining it, they're actively working to widen and deepen it with every new signing, creating exceptionally high switching costs for their customers and securing their position as an indispensable rather than just an ordinary supply partner.
And we've also seen how they skillfully navigated those recent macroeconomic headwinds, making those deliberate strategic trade-offs, like accepting lower gross margin percentages on some products that, yes, in the short term, might pressure margins,
Unnecessary trade-off in their view.
but are ultimately aimed at achieving long-term market share gains and deepening those customer relationships to an almost unbreakable degree. And of course, the big question mark that remains is the stock's premium valuation. It reflects undeniable market confidence in their unique model, but it also demands near-flawless execution and sustained, superior growth for years to come.
You know, this whole discussion raises an important, broader question for you, the listener, to perhaps ponder. In a world that's increasingly focused on digital transformation, supply chain resilience, and squeezing out every bit of operational efficiency, how much is true, deep operational integration and last-mile automation, like Fastenal provides, truly worth to a large enterprise across various industries?
What's the real value of that embeddedness?
Exactly. And what might Fastenal's success in achieving this level of integration in the MRO space tell us about the future value proposition of suppliers, not just in industrial distribution, but potentially across all industries? Is this level of becoming truly embedded, almost symbiotic, the new gold standard for enduring business success and competitive advantage?
That's a great thought to end on. Think about that for a moment. Whether you're directly managing inventory on a factory floor, making critical investment decisions, or maybe you're just intensely curious about how global supply chains really work behind the scenes, Fastenal offers a truly fascinating case study in strategic evolution, operational resilience, and building a genuinely sticky, indispensable business. We hope this deep dive has given you a valuable shortcut to being truly well-informed.